So I think today's quote unquote lesson or review or whatever you want to call these things is probably the most, I think, interesting one I've put together yet. It's probably the most advanced one, so it may not make sense to everyone from the perspective that it requires that you watch the other ones at least and probably have even more knowledge beyond that. But I thought I'd sort of start to evolve what we've been doing. And we always have to look at companies and investment opportunities with the perspective that we're trying to make good investments. And we started off just sort of understanding what financial statements a company provides, and then seeing what we can divine from that. And what's interesting is it's a very iterative process, and a lot of the young investors I meet, after I teach them the very first elements of the process, they sort of decide that they're the greatest investors who ever lived and don't need any more understanding. But the reality is that financial statements are probably like many things. They look very simple, but they're inordinately complex. What you can divine from them is more complicated than you can even imagine. And we're going to go a little bit further into that with respect to something called capital efficiency a little later. And like most lessons, again, we have a company that we're going to use we're using it more as a muse or a conversation piece than we are as a serious examination into the company. But of course, we're going to try to examine it as best as we can in a few hours. And that company is called Checkpoint. Ticker is CHKP. It's a software company. And we're going to look at that. And then we're going to talk also about Warren Buffett. I like to talk about great investors. And Warren Buffett is arguably the greatest of all time. And I'm a avid Buffettologist. I'd say he's influenced me in my investing more than anyone else. And we'll talk about Buffett quite a bit. So where do we get started? Well, maybe we can talk about what capital efficiency is, because it's going to dive into, it's going to be related to kind of what we're talking about. And you've probably seen at some point some of these ratios like return on assets, return on equity, return on book, tangible book, invested capital, etc. And what you probably haven't seen is something called the Buffett return. And I actually have this book. Let me run and get it real quick because it's pretty important. And it'll tell you something important about how I do what I do. The Money Masters. It's by John Train. I think it's out of print, so you got to find a used copy. I had a first edition copy and I gave it away to somebody, which is foolish. So I had to go buy this on Amazon for $3, which is a very good investment, but the entire thing's marked up pretty bad. Anyway, it's if you're familiar with Jack Schwager's books, which I also recommend, John Train wrote the first Jack Schwager book before probably Schwager was even born. What's interesting about this book is that it's sort of similar to the Schwager books. It goes through investor by each chapter is an investor, and the first chapter is about Warren Buffett, and it's got some things in here that nobody knows about Warren Buffett, which is pretty cool because you would think someone who's the most successful investor ever, the richest man in the world, that's somebody that has been studied and sort of everybody knows everything about Warren Buffett. But the reality is, there's things in here that are really not understood about Warren Buffett. And one of those is the so-called Buffett return, which is a ratio, which we'll talk about in a second. But what is capital efficiency? And like all of these, I sort of put the new things that I am writing in red, and I put the old things in black. So each lesson, you can see what I added to our little PowerPoint. Our PowerPoint's now like 74, 75, 73 slides. So it's almost not quite a book, but it'll be a book sooner or later. So what is capital efficiency? Well, I define it as capital efficiency as a concept. And I think that's really important, is that we are always taught in probably it comes from school where we're taught to memorize things and not think about the concepts behind them. And in business, investing, and finance, it's way more important. It's important in chemistry, it's important in math, but in business and finance, I'd say it's the most crucial, where you actually have to understand concepts and not formulas. And so the concept of capital efficiency is that we're comparing a business's assets, the assets that business requires to generate a profit, with the amount of profit being generated. So that's a simple concept, but it actually is extremely tricky to sort of understand. For instance, what assets are required to generate a profit, and that's maybe the hardest part of this. And so is it desirable or undesirable? Obviously, if you think about it from a plain perspective, you'd much rather, let's say you needed $1 million of capital to make $1. That would not be a capital efficient business. If you needed $1 to make $1 million, that would be an extremely capital efficient business. And why is capital efficiency important? Obviously, as return goes to zero, you could have alternative returns, right? You could decide not to make that capital investment and instead take your capital and put it in something returning higher. The other concept is that there's volatility around this quote unquote capital. And what is the capital we're talking about? Well, we're actually talking about the balance sheet. So we're talking about things like inventories and property, plant, and equipment mostly. So and this becomes a very, very interesting conversation. Let's look at some examples. Apple is one of the most capital efficient companies that exists. So let's pull up an Apple Apple financial statements, we'll say. And so let's see, last quarter, Apple generated, well, let's just say for the last 4 quarters, Apple generated about 50, 60, and 70 billion in cash flow for the trailing 12 months for the last 4 quarters going backwards 3 times. So on average, they're making about 60 billion on a full annualized rate. So the book is called The Money Masters, and it's by John Train. I'm sure it'll go out of print. It's been out of print. I'm sure it'll go more out of print tonight. But it actually talks about some wonderful investors and you've never heard of. One that's really fascinating is actually a guy who just died, is Robert Wilson, who was a New York trader who was extremely successful that, again, almost nobody's ever heard of. So these old books can sometimes be rather nice. I like how they say the go-go hedge fund days of the 60s, which is pretty humorous to anyone who's been in the hedge fund industry recently. So anyway, let's get back to Apple. So Apple's made $60 billion on an annualized basis, so on a 4-quarter trailing basis. And so the question is, what did it take for them to make $60 billion? We all want businesses that make cash flow, or at least I do. And I know others don't. But I certainly want to make as much cash flow as possible for my businesses. And the question is, every business needs assets to create those cash flows. And on a balance sheet, it's supposed to be a complete, comprehensive description of a company's entire asset base. And there's concepts like off-balance sheet assets, and we don't have to get into those. But in general, by law, the balance sheet has to contain every asset the company has. And the assets of Apple look pretty simple. You have 230 billion in cash and 305 billion in total assets. So really, if you exclude the cash, you're left with 72 billion of quote unquote real assets. But you can actually take that a little further. Buffett defines in this book, the Money Masters, again, something I don't think he's ever talked about publicly other than in this book, which almost nobody's read, that he looks at the asset base as the firm assets, which is maybe an old name for property, plant, and equipment, and inventories. And why are those assets that are consume capital? And so basically, the way you look at it is inventories, you have to spend money to make your inventory, right? And you hold that inventory and you hope to sell it for a higher price, because that's what a business is. You make something and then you sell it for a higher price. How much higher? That's up to the market. But that inventory is capital that's being consumed. You have to hold that capital. Apple, for instance, here has about $2.2 billion of inventories. Presumably, those go into, any accounting student knows this, goes into raw materials, work in progress, and finished goods. So raw materials would be, glass. I don't know what Apple holds in their stores, in their inventories, but something like that. Finished goods is probably the bulk of it, where they have finished iPods and iPads that they're, and iPhones most especially, where they're going to be reselling those to retailers, for instance. So inventories are capital that you have to put up that money, right? So before you sell a product, you actually have to spend the money to make that product. And that's capital. That's capital that you have to put into the business. And if you're a retailer, and we'll see those in a second, the capital you have to put into your business is enormous, because the margins you're making on your resale are very limited. Whereas the amount of money you have to put in your inventory relative to the amount of money you're making, that's what capital efficiency is all about. Property, plant, and equipment is the most interesting part about all of this. Property, plant, and equipment, of course, is any expenditure that its expected life is greater than 1 year, right? So that includes things like buildings and plants and all those types of things. And so basically what's really remarkable, and this kind of dawned on me as a young investor maybe 10 years ago or 7 years ago, inventory is usually valued at cost, to answer that question. What's really remarkable, and this should blow your mind for a second, Apple is worth $600 billion. They're making $60 billion a year. That's 10 times earnings. But what's amazing is if you look at this property, plant, and equipment, think for a second about this. $23 billion of property, plant, and equipment. What does that mean? Does anyone have an idea? Take a guess. Apple has $23 billion of property, plant, and equipment. How do you interpret that? Think about that for a minute. It really is an interesting way to think about it. Well, we know what PP&E is. I'm not asking you to define PP&E. Everybody knows what PP&E is. It's, again, machines, real estate, things like that. And no one's really getting it, which is great because I feel so proud of myself for understanding this as a young investor. The theory, the reason this is fascinating, Apple's entire property, plant, and equipment is worth $23 billion. Why is that so interesting? The market cap is $600 billion, okay? But you could recreate the entire Apple business if you had $23 billion. And there are people with $23 billion. You could actually replicate. Think about, trying to copy something, photocopy something. You could actually replicate all of Apple for $23 billion, right? That's all it would cost you. The current value of all of their assets. Imagine making a Apple in a copycat Apple. We'll call it Crapple. And this Crapple company, you could actually recreate every machine, every desk, every office, everything in the whole company with $23 billion. But why is the company worth $600 billion? That's the interesting part. There are businesses where you can generate a high return. So if we add this up, we get that they're making $63 billion off of $23 billion every year. So that's a 250% return. There's no hedge fund on the planet that has that kind of return. And so they're arguably the best investors ever. So obviously if you recreated this company, Apple, with your new brand name, it would not have the same brand loyalty and brand value, and you wouldn't have the same revenue and earnings. But there are businesses that you've never heard of that don't have that kind of brand loyalty. They're much different. They're business-to-business companies, and they're good examples, pharmaceuticals. Doctors don't care what company makes a drug. They don't say, oh, well, I don't trust this diabetes drug because it's not made by Merck. No, they prescribe the drug if it's safe and effective, and they don't really care if Merck made it or your new startup pharmaceutical company made it. There are businesses where it totally doesn't matter what your brand is. And there are companies where you could completely recreate a business like this and generate high returns. And that's sort of the essence of arbitrage. And there's other sort of reasons why these moats exist. And Warren Buffett was one of the first investors to sort of understand that there's something about looking at return on capital, whether you define that capital as assets or book value or whatever you want to define it as. Warren Buffett's inventory plus firm capital. At some point, what you're realizing is that the higher that return, the more likely there is to be some kind of moat or some kind of barrier that is stopping new competitors from coming in. And it's often just brand, right? It's often just, customers love Coca-Cola. They've never heard of Martin Cola, and they're not going to drink Martin Cola anytime soon. But again, in pharmaceuticals, that's not the case. That's not the case. In medical devices, that's not the case. There's often something else that's stopping these companies from coming in and competing away that fat margin. Everybody would love to, spend $20 million to make $60 million a year. To take Apple's numbers, divide them by 1,000. That's a crazy return, because not only you only have to spend that $20 million once. That's the crazy thing about Apple. They spend the $20 billion one time, and they make $60 billion every year. When you think about how insane that is, why doesn't that just disappear? Well, one reason is their phones work and they don't blow up like Samsung's. So they have a lot of brand loyalty. People love their phones. But one of the things about extremely high rates of return is that eventually they should be chipped away by competition. And it really depends on the moat. There are different moats in industry. One is sometimes you have an entrenched customer that's a moat not because of brand loyalty, but they're a moat because they're forced to be a moat. You see that a lot in software, where you can't change your software system every year. You got to kind of make your choice. Same thing works with drugs. Once you start taking drug, most people take it for many, many years. So it's interesting to sort of think about and look at return on capital and try to sort of back into what is going on at the root of the business. Why aren't there competitors coming in and taking this return? Sometimes the return is low. I'll give you an example. This is probably the highest capital efficient company there is. If I look at Ford, we got numbers down to 15%, 19% returns. And these are good years for Ford, right? I'm just looking at the last couple of quarters. We're in an economic recovery. This is the sort of time when Ford does well. There's periods where Ford will lose money. And Ford is a successful company. But in that book that I mentioned by John Train, Buffett talks about how capital inefficient companies like Ford and GM are, and they are. And these are the kinds of businesses that you would not want to replicate. For instance, the cash flow of Ford is trailing 12-month basis, $13 billion. And to replicate their business, you'd have to put up $71 billion of capital. Well, that's a very different deal from Apple, right? Where $20 billion makes you $60 billion. Here, $71 billion makes you $13 billion. So it really is like it's backwards. And that's sort of the point here, is that brands matter with cars. They matter a lot less, and margins are low. Customers are very price sensitive, and so forth. So when I looked at Checkpoint Software, which is a company we're going to focus on in a minute, I found this astounding return where they have virtually no capital. In fact, they don't hold inventories. They're a software company. They can't hold inventories, right? So their actual only asset is their fixed assets, which are $54 million, which are probably a couple of offices and things like that. And they make $200 million a quarter. And if you think about that, if someone said, can you scrounge together $50 million? Well, I could, a couple of friends, maybe you could. And then after that, you would make $200 million a quarter. That's almost $1 billion a year off $50 million in capital. I would love to just completely copy whatever Checkpoint's doing, maybe hire their team and go ahead and just copy everything. And if I can make half that money, a tenth of that money, I'd be happy. And that's what's fascinating about these kinds of companies. Obviously, what's important to understand is that from a stock market perspective, you don't get that same deal, right? The company got that deal. You have to pay whatever the market price is, which will be very high for a company like this. But the question really is, if it's that easy for maybe a new company to come in and say, you know what, I want to start a software security company. All I have to put up is $50 million. I could be just like Checkpoint and make $800 million a year. I make 13 times my money in my first year. Now, obviously, Checkpoint's been around 13 years, and you're not going to do that well that quickly. But it does tell you a little bit about the kind of business you're in, and most importantly, what you have to pay attention to when you're forecasting. Because I think that's the question. You have to sort of forecast the future, and we haven't done that yet for Checkpoint. But the point is that, no pun intended, is that one has to sort of carefully think about, well, why does this business exist? Which is a very sort of existential question. But what are its customers really after? What is the company after? Why are they getting the margins they're getting? They have about 50% operating margins, which is insane, and almost no capital. How do they do this? And what's to stop? What's to keep their margins this high? What's to keep their returns this high? It doesn't seem like it's possible that they could be this high. It's sort of the old saying, easy come, easy go. And so one has to sort of think about that pretty carefully. So anyway, let's go back to Buffett a little bit. We'll probably talk about Buffett for a very, very long time. He is the greatest of all time, the GOAT investor. And I like to think of people like Buffett in the vein of Albert Einstein, who had his Annus Mirabilis, which translates in Latin to miracle year. And the point is that when people achieve these achievements that are otherworldly, almost supernatural. I think it's a good term to use. Buffett introduced concepts that people never anticipated in business, like Einstein, in some ways they were probably floating around, but he sort of put them together and applied them. And what's most interesting about Buffett is he learned the Gschool school of investing and then sort of totally threw it away. Ben Graham and his professor at Columbia. And so the flow generative businesses we'll talk about at some point, but Buffett realized that on this capital efficiency stuff, what's amazing is that you could have positive working capital, so much so that you could use that working capital to invest. One moment. For instance, I define capital a little bit differently from Buffett. I like to include accounts receivable and accounts payable, because there are businesses where your customers literally give you money to hold for them. And sometimes you can actually use that money to invest. And there are some businesses where your customers expect you to give them credit. And there's the same applies with bills. There's some businesses where customers expect you to pay upfront. When you go to a restaurant and you say, I'll pay you in 30 days, well, that would be actually a great result for a Fortune 500 company, but it's a terrible result for a restaurant. So restaurants expect you to pay upfront. But law firms and other firms like that, you could be paying over 60 days or 90 days. So every business is different. And I think that working capital in general is something that is important to pay attention to when you think about capital efficiency. But Buffett took it to the next level when he realized that you could get float generating businesses and use their float to do things. He also realized, I think somewhat early in his career, that private equity is the ultimate arbitrage. And this is something where he's basically strayed away from trading stocks and investing in stocks when that was sort of his beginnings. And almost all of the money he's made in the last decade, I would say, comes from private equity, from actually acquiring companies at low prices and keeping them forever. And then he sort of understood the moat concept that I talked about, and all ties in the capital efficiency to some extent, but that there are companies where their discount rates when you analyze and calculate their value, their discount rates are often very close to zero, which is really remarkable. A couple other things about Buffett that are important to understand are his image and reputation. He focused on that maybe more than any investor I've ever seen. And some of it is sort of manufactured, some of it is authentic. One of the things I'll say about Buffett, you might say, well, what can I learn from Warren Buffett that somebody else hasn't? You'd be surprised. Again, I wager that most investors have never read this book, which is really remarkable because it has an interview with Warren Buffett that is old and reflects his thinking. And anytime you can get something like that, it's great. But I'll tell you a story. I have a friend who lives overseas, and he manages a very small hedge fund. It's somewhat insignificant, you would argue. He's a great investor. Like me, he's a big fan of Warren Buffett. And what he's done is he's actually made a friendship with Warren Buffett. He's only 27 or something, and he just basically follows Buffett around. Whenever he comes to America, he tries to sort of look up what Buffett's doing. Sometimes Buffett will be giving a speech at a school or something like that, and he'll go to the speech and he'll just follow him around. And eventually, Warren Buffett's a very nice man. That evening he said, "Oh, you guys came from such a long way. I'm having dinner tonight at this restaurant. Why don't you join me?" And he got to talk to Buffett for 2 hours. Just him and a couple other guys, his friends. And, to be able to pick the greatest investors of all time's brain for 2 hours, he answered every question. There was not one question where he said, I'm not comfortable answering that. And this was last year, or 2 years ago, I forget. But it wasn't, 30 years ago. So even people like Buffett you're able to sort of meet them, and if you're that interested in it all, it is possible. I'm not saying it's easy. But if you can't do that, reading books and reading everything you can about the person will probably be a pretty good replacement.